What's the market pricing in for next week at the moment?
Well, it's pretty much a given based on the Fed funds futures market, about a 90% chance. But while we may get that cut, I think the Fed is going to couch it in, well, we're going to be stopping for now. Because if the Fed is on this, I'm taking an insurance policy type mentality to rate cuts, well, then 2 to 3 is usually qualifies based on historical patterns back in the mid-90s.
And do you think that the Fed is going to be open to more cuts after this decision?
I don't. First of all, I don't even think they should be cutting, but let's just assume that they don't want to fight the market and just going to go with what the market has said. I think they don't want this to be seen as the beginning of a rate-cutting cycle, which would be responding to a dramatic slowdown in growth. They keep having this vision of we're going to create a soft landing. And I think now with the possibility of a light trade deal and a possible resolution to Brexit, there's even more reason for them to pause after the cut next week.
Mike, we were talking about this with Stephanie Link yesterday. I get the point that the market is very much priced in a rate cut, so would be surprised, therefore, if it didn't get it. Yeah. That said, in terms of the issues that are most important to investors, equity market investors at the moment, the last couple of meetings, the Fed had a little bit more focus on it, a little bit more import to it.
Yes. Yeah, I agree. I mean, I think right now the data have come in the direction of what the baseline Fed expectations were. It doesn't seem a very acute need. Now, the one thing I would say is if they are attentive to how Treasury yields are trading in the yield curve, getting one more cut would likely, get the 2-year note yield back down to where you'd want it relative to Fed funds and all the rest of it. So maybe it still feels like an adjustment. But I do think this one is not necessarily a unanimous call and probably will not be.
Hey, Peter, can you weigh in on some of the funding issues that we've seen in the repo market?
Well, I think it's your classic major supply and demand imbalance. You have massive Treasury supply. We saw the budget deficit hitting $1 trillion, just shy of it. So massive Treasury supply and not enough demand. The dealer community, the bank dealer community, at least in the fourth quarter, doesn't want to take on too much inventory, so we can see that they're already loaded up. The non-bank dealers are rushing to get financing to help cover some of those holes. And you have this major imbalance where the Fed is now stepping in to be that buyer to soak up that excess supply, which is essentially monetizing short-term T-bills. They want to call it a new modern-day open market operations. But it's really slowly creeping into the monetization realm. Now we'll see whether in the first quarter, whether banks then step up because they're less worried about year-end funding issues, and maybe some of this pressure could ease. But it's certainly the first time in a long time that massive supply of treasuries is beginning to cause some major reverberations when the demand side is not there to meet it.
Peter, I wanted to switch focus. I know you're very against negative rates. So all in all, with his final meeting behind him now, how do you summarize the legacy of Mario Draghi?
So I guess you can say the positive is that he saved the euro in this whatever it takes approach. But on the other hand, he's killed the European bond market. He's damaged dramatically the profitability of the banks. He's killed the savers. And he's what I think is overall poisoned the entire financial system in Europe. So I think his reputation in the years to come will be tarnished when we see the reverse of this, when rates at some point go back to positive and these incredibly microscopic and dangerously low interest rates reverse themselves.
I'm going to have to say, Peter, just to put a different side to that, I think the whatever it takes created a incredible window for Europe's governments to act to get their economies back on track, that they didn't take that action. And after that, Mario Draghi didn't have too many other options but to continue to suggest he would do whatever it takes to support the currency. And I find it odd that everyone now says, oh, Christine Lagarde's going to come in and encourage all these governments to expand fiscal policy, and that would help save the economies. But Mario Draghi said that in every single press conference since 2012, that fiscal policy spending would help. But he just didn't see any support from governments.
I think it's underappreciated that the damage that he did to the European banking system prevented healthier and quicker growth. You need a healthy banking system to create the foundation for faster growth, and Mario Draghi damaged it. Fiscal stimulus, fiscal spending by the government is only a short-term fix. So I don't think that would have brought European economies to any sustainable rate of growth that a healthier banking system would have.